Well, if you look at Berkshire, you will find that it really doesn't do much of conventional asset allocation to categories. We are looking for opportunities, and we don't much care what category they're in. And we certainly don't want to have our search for opportunities governed by some predetermined artificial bunch of categories. In this sense, we're totally out of step with modern investment management, but we think they're wrong.
Yeah. And incidentally, we have 80% of our money or more, well over 80%, tied to this country and to the dollar. So it's not like, we've left the country or anything of the sort.
But when have you done a big asset allocation strategy?
Never.
Yeah.
Yeah. We end up with peculiar asset mixes. I mean, if the junk bond thing had gone on a little longer, instead of having $7 billion in there, we might have had $30 billion in. But we were doing that simply based on the fact that it was screaming at us. And we do the same thing with equities. I mean, back for many years, we had more than the net worth of Berkshire in equity positions, but they were cheap.
And I want you to remember one of my favorite sayings as you do this asset allocation. If a thing's not worth it doing at all, it's not worth doing well.
Yeah. You can see why Ben Franklin turned the mantle over to Charlie.
Tried to buy warehouses with a lot of family money, and he just stopped. Whatever he bid was always topped by some professional manager managing other people's money on a fee basis. So this is a very peculiar era where all these asset classes have been driven to very high valuations by all historical standards. Some investment operations are very ethical in this regard. I think Howard Marks is here today. He sent a lot of money back and stopped soliciting money from his clients in certain activities where the opportunities went away. That's the right way to behave, but it's not normal.
Yeah, I don't think you'll mind. I didn't know Howard was here today, but those actually are Howard's figures for one of his funds. And like I say, we were doing similar things. We didn't know it at the time, but we found out we had some similar positions later on. About 5 or 6 years ago, when the terms of these deals were somewhat different, I actually had a fellow call me whose name most of you would recognize, and he started asking me questions about the reinsurance business because he said he was thinking about buying a given company which got sold, and he didn't really know much about the business, but that unless he spent these X dollars, he was going to have to give it back to his investors in a few months because the term of the initial sign-up period expired at that point, and any unexpended funds were to be returned, and he was going to get 2% a year on those funds regardless of how they did. So he was looking at businesses that he didn't understand with the hope that he could place the money. Charlie and I are at a disadvantage in buying businesses because we have almost all of our net worth in the downside as well as the upside. So, if we had a 2% fee and 20% of the profits and a goodbye kiss for the losses, that's a different equation that exists at Berkshire. So we run it as if it's 100% our money, which it is close to 100% of our net worth, and we will own the downside, and we don't get paid for spending the money. We get paid for making money, and it's tough. Competing right now is tough and likely to be relatively futile, although we have one or two things that could happen that could involve the expenditure of real money.
Yeah, I don't think any of the businesses that have sold to us over the years, which are run by the kind of people we like being associated with, would have wanted to sell to a hedge fund. So there is a class of assets out there that doesn't want to deal with hedge funds or private equity funds. Thank God.
Yeah, we've seen no deal anybody else has made in the last year that we wish we had made. Now, that was not the case 15 or 20 years ago. There used to be plenty of deals made with other people that we we would have liked to have made if they'd come to us. But I've seen nothing that if it sold for 10% less than the advertised price that we would have had any interest in buying. So we are in a different world right now.
I'm one of these doctors that really doesn't know anything about money or finance. The money comes in, but I don't know what to do with it. I'm not able to really evaluate the financial strength of a company, but I can evaluate the ethical strength of the company, and that's why I feel real comfortable, I think most of us here, having our savings in Berkshire Hathaway. And
Thank you.
This question has probably been asked in different ways already, but several years ago, a fellow I know who had been manager of Magellan Fund warned that we were going to have a terrible decade or so in the stock market because of all the things people have brought up so far, the increasing interest rates and runaway spending and decreasing dollar and stagflation maybe right around the corner, Social Security problems, and even what Charlie Munger referred to is that most of our best and brightest graduates, I find, are going into money management rather than they're not becoming doctors or molecular biologists or PhDs in chemical engineering. And so in view of the fact that a year or two ago, there was still an ebullience of emotion about the stock market going up and making everyone rich just by having their money in the stock market, it seems like that ebullience has dropped, and I'm hearing in anticipation of a bear market. And you wrote, I think several years ago, that it's hard to make money in a bull market, and the real opportunities come in a bear market. So I'm wondering if you would give us a clue as to what your strategies are going to be if it's really true that the market gets dismal over the next few years.
Well, if the market gets cheaper, we will have many more opportunities to do intelligent things with money. Now, whether we'll blow on the money in the meantime or something is another question. But you know, we are going to be buying things, one thing or another, operating businesses, stocks, high yield bonds, whatever. We're going to be buying things for as long as I live. Just like I'm going to be buying groceries.
Longer than that, Warren.
Yeah. Well, yeah. Charlie's just waiting to take over after I. And I'm going to be buying groceries the rest of my life. Now, would I rather have grocery prices go up or down if I'm going to be buying groceries tomorrow and next week and next month and next year? And the answer is obviously, if I'm a net buyer, I will do better if prices are lower. We're not good at forecasting markets. I mean, knew that we were getting enormous bargains in the mid-70s. We knew that the market went crazy to some extent in the late 90s. But we don't have much. We don't spend any time. Charlie and I spend no time thinking or talking about what the stock market is going to do because we don't know. We do know sometimes that we're getting very good value for our money when we buy some stocks or some bonds, as it may be. But we are not operating on the basis of any kind of macro forecasts about stocks. And there's always a list of reasons. You gave a few. There's always a list of reasons why the country will have problems tomorrow, but there's always a list of opportunities which don't get mentioned quite as often. So we don't sit down and make a list of the bad things that are happening in the economy and the good things that are happening, and therefore expecting the stock market. It might not. It doesn't behave that way even if you could correctly forecast some of the bad things or good things. Overall, I'm an enormous bull on the country. I mean, over time, this is the most remarkable success story in the history of the world, if you think about it. I mean, in 1790, we had less than 4 million people in this country. There were 290 million people in China. There were 100 million people in Europe. And they all had the same intellect we had. They were in the same general climate. They had lots of natural resources. And 215 years later, those 3.9 million people, I think, actually, have 39 million people, I think, actually, have 30% or so of the world's GDP. So it does not make sense to bet against America. That doesn't mean all our policies are smart or anything, but I do not get pessimistic on the country. I worry about the big worry is what can be done by either terrorists or governments that have access to nuclear, chemical, or biological weapons. But in terms of the basic economics of the country, your children are going to live better than you live, and your grandchildren are going to live better than your children live. And we do not focus on macro factors. Charlie?
Well, I agree with you that the economics of the country are probably going to increase for a considerable period ahead. But I suspect that in very important ways we are at or near the apex of a great civilization.
You heard it here first, folks. If you leave the NCB, nuclear, chemical, biological, but I do not feel that way, but you'll get to see which one of us is right 20 or 30 years from now. I have seen more people pass up opportunities because they get focused on a single economic variable or a single problem that the country faces, and they forget about the good things. I mean, if you can buy very good businesses at attractive prices, it's crazy to say, I think I'll sit this out because it might get a little cheaper next year or something of the sort, and because the world's going to go to hell. We've never operated that. We've never decided not to buy a business we like because of a macro view, have we?
Not yet.
Okay. It's hard to get him to really agree with you. I've been working on it for years. Number 11. There's no doubt about it that there is far more money looking at deals now than 5 years ago, and they're willing to pay up more for the good but mundane businesses that we've been successful at buying in the past. And you mentioned the private equity firms, and they're bigger than ever. The hedge funds have gotten into the game to some degree, and if someone is auctioning off a business today, this has changed just very slightly in the last 4 or 5 weeks because of some change in the junk bond market, but not in any significant degree. There were people lined up to bid on almost anything. In fact, you have private equity firms selling their businesses to other private equity firms, and there are a lot of companies that are being sold to someone who's buying them to resell in a fairly short period of time. We can't compete in that field, and that's a source of distress to us, but that's the way it is. It won't go on forever in our view. We still occasionally, as this deal I mentioned to you, the party on the other side, and we made a deal that did not go through an auction process, and we see that occasionally, but we don't see it anything like we saw it 4 or 5 years ago. So in terms of the near-term outlook for Berkshire, in terms of doing what it's important that we find it extraordinary, both Charlie and I have over the decades, just how fast things can change. There have been at least 3 times, maybe more, where it's looked to me in my own career where it looked like there was so much money sloshing around that it would be impossible to do intelligent things with money. And I actually terminated a partnership back at the end of 1969 because I felt that the money was coming out, of the woodwork. There were all kinds of people that wanted to use it and compete, and I just didn't feel we could do intelligent things. Within 4 years, I saw the greatest opportunities that I've ever seen in my lifetime, and we've had several experiences like that. In 1998, when long-term capital management got in trouble in the fall of 1998 and other things were happening, you had incredible opportunities available in the investment world. Now, people were just as smart then. They had all these people with 150 IQs running around, and they actually had money. But the world became paralyzed for a short period.